All right, so the crypto market just got hit by an absolute shockwave. We're talking a record-breaking liquidation that vaporized billions of dollars, and it has left everybody scratching their heads, asking the same thing. Was that the big flush out we needed before a new bull run, or was that just the first warning sign of a long, painful bear market? The signals, and this is the crazy part, are pointing in completely opposite directions. Today, we're going to try and make some sense of all this chaos.
And this quote right here from a Coinbase report aimed at their biggest investors really gets to the heart of the mystery. How on earth can a crash that just wiped out $20 billion be seen as a good thing, a necessary reset? That's the paradox we are going to unpack.
So here's how we're going to tackle this. We're going to look at the market through 4 different lenses. First, the technicals, what the charts are saying. Then, the macro picture. After that, we'll follow the institutional money, and finally, we'll look at the human factor. By the end, you'll have a much better framework for understanding these wild moments in the market yourself.
Okay, first up, the technical code. This is all about looking at the charts, at the historical price patterns, and all the indicators that traders live and die by. Basically, are we seeing something that has happened before?
And we have to start with one of the most important indicators out there, the 50-week moving average. Just think of it as a long-term health check for the market. For chart analysts, whether the price is above or below this line is a massive, massive signal about where things are probably headed next.
The rule of thumb here is pretty simple. When Bitcoin's price is trading above this line, historically, we're in a bull market. But when it breaks below, well, that's been a pretty reliable sign of a bear market. And here's the big flashing red light for technicians right now. For the first time in this entire cycle, Bitcoin is just closed below that critical line.
And listen, it's not just that one indicator. Analysts are seeing a whole bunch of bearish signals lining up. You've got these bearish divergences popping up on the weekly charts, which look eerily similar to what we saw back at the 2021 top. On top of that, a lot of altcoins are looking structurally weak. And historically, after a huge liquidation like the one we just had, prices tend to drift lower, not just rocket straight back up.
Okay, so let's zoom out now and move to our second lens, the macro picture. Because, crypto doesn't exist in a bubble. It is tied to everything happening in the global economy. Interest rates, politics, you name it.
So one of the biggest global forces happening right now is the end of what's called the carry trade. Here's the simple version. For years, you could borrow money in Japan for basically zero interest. So investors would borrow tons of yen for free and then go buy other stuff with it. But now, Japan is finally raising its interest rates. That free money spigot is being turned off. And now all those investors have to start selling assets, and that includes risky stuff like crypto, just to pay back their loans. That's a huge source of selling pressure.
Meanwhile, we're getting this really weird signal from the U.S. Federal Reserve. They just ended their policy of quantitative tightening. Now, on the surface, that sounds great for the markets, right? But a lot of the more experienced investors, they see that as a warning sign. It's like the Fed sees something creaking or about to break in the financial system, and they're stepping in early to try and stop it from falling apart.
So the charts are looking kinda bearish, and the bigger macro picture looks pretty risky. That brings us to our third lens, institutional money. So, are the big players, the so-called smart money, heading for the hills like you'd expect?
First, let's just let the sheer scale of that crash sink in. October 10th saw a record 20 times billion dollars in liquidations. To give you some perspective, that's nearly 20 times bigger than the entire collapse of FTX. It was a day that absolutely, positively terrified the average retail trader. But, and this is where the entire story flips on its head, look at this. After 6 straight weeks of money flowing out of crypto ETFs, the week after that massive crash, we saw the first positive inflows. This is huge. It tells us that while retail traders were panic selling, the big institutions saw a discount. They saw a buying opportunity. This is the very heart of that bullish reset idea.
And what's really fascinating is where that money is going. It's not just a blind buy Bitcoin move. We're seeing very strategic investments into specific areas. There's strong inflows into staking and restaking. We're seeing a surprising comeback in NFTs and gaming. And there's huge interest in real-world assets, with giants like BlackRock jumping in. This doesn't look like panic at all. It looks like calculated, long-term conviction.
All right, let's bring it all home with our final lens, the human factor. This is all about the psychology of the market, the stories we tell, and, frankly, how we all react when things get crazy.
One analyst said this right after the crash, and it just nails a classic market dynamic. These moments of max pain, where the average person feels like they just can't take another drop.
They often happen right around the market bottom. When your friends who never talk about crypto are suddenly texting you in a panic, that can actually be a sign that we've hit a point of extreme fear.
And this leads to a really interesting new way of looking at all the selling pressure. Some people are starting to think that Bitcoin is having its own version of an IPO moment. Basically, the very first investors, the ones who are sitting on absolutely life-changing money, finally have a market big enough where they can sell some of their holdings without crashing the price. So what we're seeing might not be a bear market at all, but a historic transfer of assets from the early believers to a whole new wave of giant institutions.
This quote just perfectly sums up the two different mindsets, doesn't it? For the investor who's panicking, all this volatility feels like a crisis. But for the prepared investor, the one who has a long-term plan, these moments are a test. They don't see it as a disaster. They see it as an opportunity that fits right into their strategy.
Okay, so we've looked through all four lenses. The technical charts are flashing warning signs. The global economy feels risky. But at the same time, the institutional money is actually buying this dip, and the human psychology of it all suggests we might be at a point of peak fear. So what are we supposed to do with all this conflicting info?
Well, the biggest takeaway is that there isn't one simple answer. The market isn't just bearish or bullish. It's both, at the exact same time, depending on how you look at it. The bearish technical signals are real. The macro risks are absolutely real. And the fact that institutions are buying is also real. The only way to see the complete picture is to hold all of these different truths in your head at once.
And that leaves us with the final and most important question. In a market this complex, where every signal seems to contradict the last, the real challenge isn't trying to find someone to tell you what's going to happen next. It's using a framework like this one to decide for yourself which of these signals matter most to your own plan. And that, right there, is the real key.